Usually when we talk about a medical diagnosis, there's this expectation of like absolute precision. You break your arm, the x-ray shows that jagged white line, and the doctor just points at the film and says, well, there it is.
Yeah, it's binary. Broken or not broken. You can literally see the problem with your own eyes.
Right. We like things to be visible. We like them to be categorized. But then you step into the world of corporate finance, and suddenly that x-ray machine feels like it's completely malfunctioning.
Oh, absolutely. It gets blurry fast.
It really does. People assume high finance is this secret language,
Mm-hmm.
like this impossibly complex math that requires an MBA just to read the menu. They see terms like liquidity or amortization, and they just immediately check out.
Yeah, they assume it's a diagnostic landscape that's just way too murky for a normal person to navigate, which honestly creates a massive barrier to entry.
Exactly.
But the reality of corporate finance is that the underlying principles are surprisingly intuitive once you strip away all that intimidating jargon.
And that is our mission today on The Deep Dive. We are taking the core financial concepts of liquidity, assets, and liabilities, and we are breaking them down so that anyone, literally, even a high school student with absolutely zero finance background, can understand how the pros evaluate a company's financial health.
It's going to be fun.
It is. We are pulling today's insights from foundational text excerpts on liquidity fundamentals, current assets, liabilities, and the current ratio. I promise you, by the end of this deep dive, you will be able to look at a corporate balance sheet like a seasoned investor. You'll see the story the numbers are actually trying to tell.
Yeah, it's such an empowering toolkit.
Yeah.
Because once you know how to read the vital signs of a business, the entire financial world becomes, well, a lot more transparent.
Okay, let's unpack this. The entire foundation of our discussion today rests in one single concept, and that is liquidity. The formal definition revolves around a company's ability to meet its financial obligations as they come due. But how do we actually visualize that in a way that makes sense?
Well, think about liquidity like checking the fuel gauge before a long road trip.
Okay, I like that.
Right. If you are getting ready to drive across the country, it genuinely does not matter how beautiful the car's paint job is, or like how powerful the engine is, or how incredible the stereo sounds.
Because if your fuel gauge is on empty, you are not going anywhere.
Exactly. You're stuck in the driveway. Liquidity tells you if you have enough readily available resources, enough fuel to keep the company moving forward today.
So a company could have a world-changing product, but if it runs out of gas on a Tuesday, there is no Wednesday.
That's the harsh reality of business.
Right. So to understand if a company has enough fuel, we first have to look at what resources are actually available to burn. We need to look at the haves.
And in financial terms, those haves are called current assets.
Current assets.
Right, and the word current is doing all the heavy lifting here. It establishes a strict timeline. We are looking at the one-year rule.
The one-year rule.
Yeah. Current assets are resources that a company realistically expects to convert into cash, sell, or completely use up within one single year or, within its normal operating cycle.
Okay, so the one-year rule is our golden time frame. To really ground this, let's pull this out of the abstract textbook and into the real world. Imagine you own a retail store.
Okay.
Let's make it a high-end boutique sneaker shop.
Oh, nice. Very trendy.
Yeah, you've got the neon sign in the window, the limited edition shoes on the walls. What actually constitutes your current assets in that scenario?
Yeah.
Obviously, the literal cash sitting in your business checking account is at the very top of the list. That is pure, unadulterated fuel.
Absolutely. Cash is the ultimate liquid asset. It sits right at the top of the balance sheet. But you also have cash equivalents.
Which are what exactly?
These are super safe, short-term investments that you can convert to cash almost instantly, like treasury bills.
Okay, why not just hold cash, though?
Because holding massive amounts of pure cash in a zero-interest account means you're literally losing money to inflation.
All right.
So cash equivalents give a tiny bit of yield while still maintaining immediate accessibility.
That makes sense. Then we look at the actual physical store, the inventory. So the boxes of sneakers sitting on your shelves or like stacked in your back room.
Yeah, because you fully expect to sell those shoes to customers in exchange for cash within the next 12 months.
Right.
Inventory is a massive component of current assets for any retail business. But you also have accounts receivable.
Accounts receivable.
Yeah, that's the official term for money your customers currently owe you.
Let's explore the mechanics of that, because in a standard sneaker shop, a customer just pays at the register. But what if our boutique also sells wholesale?
Okay.
Say we supply exclusive athletic shoes to a high-end local gym for their trainers. We drop off 50 pairs of shoes, and we hand them an invoice with net 30 terms, meaning they have 30 days to pay us.
Right.
We don't have the cash yet, but we have the legal right to collect that cash within the year.
Exactly. And you've captured the friction inherent in accounts receivable right there. It's an asset, yes, but it requires collection. You are waiting on someone else to actually write the check.
Which can be stressful.
Oh, incredibly. And alongside that, you might also see marketable securities on a balance sheet. Those are stocks or bonds the company owns and can easily sell on the open market. And then we have prepaid expenses.
Okay, I want to pause on prepaid expenses because that concept completely tripped me up
So
initially.
it throws a lot of people off.
Right. My brain immediately categorized an expense as money leaving the building, like
Yeah.
a negative. How does an expense become an asset?
Well, think about your sneaker shop's lease. If you have a really great month and you decide to pay your landlord for the next 6 months of rent in advance, you have just executed a prepaid expense.
Oh, I see.
Yeah, you've essentially pre-bought a resource, the physical space to operate, that you are going to use up within the year. It's an asset because you've locked in that value. You no longer have to burn any of your incoming daily cash on rent for the next half year.
Wow, okay. You've essentially stored the fuel.
Precisely.
But let me push back here with a clarifying question, just to test the boundaries of this one-year rule.
Sure.
Let's say our boutique sneaker shop is so incredibly successful that I decide to buy the physical building the store is located in. I own the real estate outright.
Wow. Good for you.
Thanks. Now, real estate is definitely an asset. It holds tremendous value. But it is not a current asset, is it? Because if I have a bad month and I need to pay my store managers on Friday, I can't exactly pry a brick out of the wall and hand it to them.
That is the exact trap a lot of novice investors fall into.
Really?
Yeah. They look at a company with massive total assets, huge factories, sprawling real estate, and they just automatically assume the company is financially bulletproof.
Right, because they're rich.
But overall wealth is not the same thing as immediate liquidity. You can own a $20 million commercial building and still face a bankruptcy filing on a Tuesday if you don't have $10,000 in liquid cash to make your payroll.
That is terrifying.
It is. Current assets are specifically the resources readily available to pay upcoming bills. A building is a long-term asset. It takes months, sometimes even years, to list a property, find a buyer, close the deal, and convert that brick-and-mortar value into usable cash.
So you can be incredibly property rich, but fatally cash poor.
Exactly. Which is why understanding the specific timeline of your assets is vital. Having boxes of sneakers on the shelf and wholesale invoices waiting to be paid is fantastic.
Yeah.
But that incoming value only matters when we compare it to what is draining the fuel tank.
Right, because having sneakers on the shelves doesn't happen by magic. Putting them there created an obligation somewhere else. We have to look at the have-to-pays.
Yes, sir.
This is the flip side of the coin, current liabilities.
The liabilities are the debts, and just like with the assets, the word current applies that exact same strict one-year rule.
Okay.
Current liabilities are the debts and obligations that a company must pay within 1 year or within its normal operating cycle. They're the immediate claims against the company's short-term resources.
Okay, so walking back into our sneaker shop. The lights are on, the music is playing, the shelves are totally stocked. It feels like a healthy business. But you owe the Nike distributor for that inventory.
You do.
And the employees walking the floor helping customers try on shoes. You owe them their wages for the hours they worked this week.
Yep.
And every time you make a sale, the government expects its cut of the sales tax. All of these are current liabilities.
Exactly. And when you look at the balance sheet, you'll see these listed clearly. Accounts payable is the money owed to your suppliers, like the Nike distributor. If you don't pay them, they cut off your supply chain.
Right.
Wages payable represents the labor your employees have already provided but just haven't been compensated for yet. You'll also see taxes payable and interest payable on any business loans you've taken out. Oh, and short-term notes payable.
Okay, speaking of loans, let's talk about those because there's a specific line item here that sounds like a massive contradiction to me. The current portion of long-term debt.
Yes.
How can a debt be long-term but categorized as a current liability?
Let's use that building you bought. You took out a 10-year commercial mortgage to buy the property. The overall loan is a long-term debt because the final payoff is a whole decade away.
Okay, I'm with you.
However, the bank expects a payment next month and the month after that.
Oh,
The specific 12-monthly mortgage payments that you are legally required to make this year are due in the short term. So that specific 12-month slice of the total debt is carved out and categorized as a current liability.
Because I have to pay it now.
If we connect this to the bigger picture, that is simply the reality of doing business. You can't just look at the massive debt 10 years down the road. You have to survive the payments due this Friday. Current liabilities are the bills coming due in the near future that keep the retail store's lights on and shelves stocked.
They are the inescapable burn rate of the business.
Very well put.
So we have our pile of haves,
Yeah.
the current assets, the fuel we can use. And we have our pile of have-to-pays. We add up our current liabilities, the suppliers, the payroll, the rent, and we owe $250,000 over the next year. We divide $500K by $250K, and we get a current ratio of 2.0.
And a ratio of 2.0 means that for every one single dollar of debt coming due this year, the company has $2 of assets ready to cover it. You have double the resources you actually need.
The business implication there is massive. I mean, you have a huge cushion. You could suffer a 50% drop in expected cash flow. Maybe a supplier goes bankrupt or, I don't know, a new competitor opens across the street, and you still wouldn't bounce a single check.
Right, you have the structural stability to absorb a shock. But what happens if we look at a just okay scenario? What if your current assets perfectly equal your current liabilities?
Okay, so you have $150,000 in the asset pool and $150,000 in the liability pool.
Exactly.
That gives you a ratio of exactly 1.0.
Yes, you have exactly enough short-term resources to cover your short-term obligations. Not a penny more, not a penny less.
But let me introduce some friction here, because I'm thinking about this from a management perspective. In a booming economy, wouldn't a ratio of 1.0 actually be a sign of a highly efficient, super aggressive management team?
How do you mean?
Well, they aren't letting cash just sit idle in a bank account. They are deploying every single dollar they have into new inventory, new marketing, new hires. Why is a 1.0 ratio viewed with such caution if it just means the company's running lean and fast?
It's a fair question. Running lean and fast is fantastic when the track is perfectly smooth. The problem is that the business world is inherently unpredictable.
Right.
Efficiency is great until a massive shipment of inventory gets stuck at a port due to a strike, or, a major wholesale client disputes an invoice and delays their payment by 90 days.
Yeah.
At a 1.0 ratio, you have absolutely zero margin for error. If one tiny thing goes wrong in your cash flow pipeline, you instantly cannot pay your electric bill.
Wow, okay. You are operating entirely without a safety net. Which brings us to the visceral panic of the struggling store scenario.
Let's hear it.
Our boutique sneaker shop hits a wall. We only have $100,000 in current assets, but the bills piling up, the current liabilities, total $150,000.
Yikes.
Yeah. We divide 100K by 150K, and we get a current ratio of 0.67.
For every dollar of debt, you only have 67 cents to pay for it.
That is grim. So what does this all mean?
It means you're in trouble. A ratio below 1 indicates potential, severe liquidity concerns. The company owes more in the near term than it expects to realistically convert into cash.
To put that in the context of the sneaker shop owner, it's Thursday night. Payroll is processed on Friday morning. Your bank balance is short, and your main supplier just called to say they're putting a hard hold in your next shipment of shoes until you clear your past due invoices.
Yeah, you are in a state of active crisis management at that point. When a ratio drops below 1, management is usually forced to seek emergency funding. They might have to dilute their equity by bringing on a new partner at a terrible valuation, or take out a high-interest, predatory short-term loan just to bridge the gap.
It's a death spiral. So we know the math. But how do investors actually apply this in the real world when deciding where to put their money? Why do investors care so deeply about this specific ratio?
Because investors use the current ratio as the ultimate litmus test for survivability.
Survivability.
Exactly. They want to know that a company is structurally sound enough to withstand the unexpected. Can they pay suppliers on time to keep the supply chain intact? Can they meet payroll without panic borrowing? And most importantly, can they survive temporary business downturns?
Like a pandemic.
Or even something smaller. If the street in front of your shop gets torn up for construction and foot traffic dies for 3 months, a healthy current ratio means you have the liquidity to keep the lights on while revenue plummets.
Okay, but here's where it gets complicated for me. My initial instinct, and I think the instinct of a lot of people learning this for the first time, is that more is always better. Right. If a ratio of 2.0 is safe and comfortable, then a ratio of 10.0 must be absolutely incredible. Like a ratio of 10.0 means the sneaker shop has $10 of assets for every $1 of debt. They must be invincible.
It's a very logical assumption, but it reveals a really fascinating counterintuitive truth about corporate finance. A very high current ratio is not always a positive signal.
Wait, really?
No. In fact, it's often a massive red flag.
How can having too much fuel in the tank possibly be a bad thing?
Because in business, idle resources are wasted resources. If a company has a current ratio of 10.2, it suggests that management is either terrified of taking risks or simply incompetent at capital allocation. They might be holding excessive amounts of cash in a basic bank account.
And while that cash is just sitting there doing nothing, it's slowly losing purchasing power to inflation.
Precisely. Instead of hoarding that cash, a smart, competent management team should be investing those resources to actually grow the business.
Okay, I see. If I have $1 million sitting in the sneaker shop's checking account, and I'm not using it to open a second location across town or launch a massive online e-commerce platform,
Right.
or design my own proprietary brand of shoes, I am being a terrible manager.
You are prioritizing extreme safety over the fundamental goal of a business, which is growth.
Oh,
And consider an even more dangerous scenario. What if that massive current asset number inflating your ratio isn't cash at all? What if it's almost entirely inventory? Yeah. A 10.0 ratio might simply mean you have a warehouse stuffed to the ceiling with a specific style of sneaker that nobody actually wants to buy.
which means it's not actually fuel, it's just dead weight.
Mhm.
So the ratio isn't just a simple pass or fail grade on a math test.
Not at all.
It's a clue. It prompts you to look deeper into the mechanics of the business to understand why the number is what it is. And it's so foundational that literal finance professionals are tested on it before they are even allowed to manage money.
Oh, absolutely. This exact concept is heavily featured on the SIE and Series 7 exams, which are the licensing exams required to be a registered securities representative in the U.S.
Yeah, the source material specifically pointed that out. Because if an advisor cannot grasp the nuts and bolts of liquidity, they have absolutely no business advising clients on where to allocate their life savings.
None whatsoever.
But for anyone out there taking those exams, or just for you trying to cement this in your head, the source gave this really fantastic, simple memory trick.
I love a good memory trick.
It strips away all the jargon and breaks it down to the absolute basics. Current assets equal money coming in.
Okay.
Current liabilities equal bills going out. And the current ratio is just asking the fundamental question, can the money coming in cover the bills going out?
Can the money coming in cover the bills going out? It's perfectly stated. If the answer is yes, you have a viable business. If the answer is no, you are essentially managing a countdown to a bankruptcy hearing.
It is amazing how much clarity that brings to the muddy waters of corporate finance.
It really is.
Let's do a quick recap of the diagnostic tools we've built today. We started with the intimidating wall of financial terminology, and we bypassed it by building our own boutique sneaker shop.
We did.
We stocked it with current assets. So the cash, the inventory on the shelves, the receivables from our wholesale clients, basically the money coming in that we realistically expect to see within the next 12 months.
And we balanced that against the cold, hard reality of the current liabilities. The invoices from the shoe distributors, the weekly payroll for the staff, the taxes, the bills going out that absolutely must be paid within that same one-year window to keep the doors open.
And finally, we use the current ratio to divide our asset pool by our liability pool, making sure our shop had the liquidity, the fuel, to survive a shock, while also learning the nuance that hoarding cash or stockpiling unsold inventory can artificially inflate that number.
Right, because we learned that the true sweet spot in business is having enough liquidity to be safe, but not so much that you're just stagnating.
It requires constant calibration. And as you digest these concepts, consider a final thought regarding the reality of managing those assets.
Yeah, this is important.
We established that inventory, like those boxes of limited edition sneakers, is classified as a current asset because management expects to sell them within a year. But the real world is incredibly messy and unpredictable.
Extremely messy.
Think about trends that evaporate overnight. What happens if consumer tastes shift violently? Think about companies that hoarded fidget spinners back in the day, or the fallout when a celebrity partnership collapses and a wildly popular shoe brand suddenly becomes, well, toxic.
The value of that inventory drops to zero almost instantly.
Instantly. Yet, technically, those shoes are still sitting on the balance sheet as a current asset. Your current ratio might look incredibly healthy on paper, projecting strength and stability to the public. But if you cannot actually convert that specific inventory into cash, because the market rejects it.
Does a high current ratio suddenly create a dangerous false sense of security for investors?
Exactly. It forces you to realize that behind every clean mathematical ratio, there is a complex, real-world context that demands critical thinking.
You always have to ask what the numbers are made of.
That fundamentally changes how you look at a retail store. The X-ray might show the bone isn't broken, but it doesn't tell you if the patient is actually healthy enough to run the race. You have to look at the quality of the assets, not just the quantity. Thank you for joining us on this deep dive. Next time you walk past your favorite retail brand or your local sneaker shop, take a look through the window. Look at the inventory sitting on the shelves. Look at the employees working the floor, and imagine the invisible tug of war happening on their balance sheet. With these new tools in your arsenal, you are officially looking at the world like an investor. Until next time.